Hello, everyone. Thank you for joining us today. Welcome to HCECU's Personal Finance Wintersession series for 2023. We're so glad that you can join us for this year's topic, Financial Independence, Why Managing Your Finances Matter. I am Terrence Brazil, a Community Engagement Specialist at Harvard University Employees Credit Union, and I'm joined by my colleague, Dominique Verjus, who is also a Community Engagement Specialist, and Magdalena Gomez, who is the AVP of Community Engagement. To begin, HUECU is Harvard's not-for-profit financial institution committed to serving the Harvard community. The credit union is just like a bank, but better in almost every single way, including servicing all Harvard students, alumni, faculty, and staff with our wide range of products and services. Remember, once you join HUECU, as a member, you are able to maintain membership for life, and your membership allows you and your family to join as well. International students are eligible for membership too. To learn more, please visit us at huecu.org/international. Next up, we have a new branch in the Longwood Medical area. We are located at 435 Brooklyn Ave, right near Sweet Green. Come on in and stop by for a visit if you're in the area. We love when people pop in to say hi. We're glad to offer free financial wellness services to all, such as this session and many more throughout the year. If you hear anything during today's session and you wish to take action, please visit us at huecu.org/thrive, where you can get access to free financial counseling, as well as learn more about financial concepts, read blogs, and download some worksheets to take charge of your financial well-being in 2023. We are hiring. If you are interested in shaping what is next with HUECU, please consider joining our Student Advisory Council. On the council, you will consult on personal finance events and content, as well as projects on an as-needed basis. This is a paid position with flexible hours and open to Harvard College students. No financial experience is required. To learn more, please visit us at huecu.org/SAC. In today's webinar, to ensure that we have the best Zoom experience possible, we have muted all the other audience members. Also, please submit any questions you have through the Q&A button on your screen. Feel free to submit these throughout the presentation and they will be answered by our presenters. You can also submit these questions anonymously through the Q&A as well. Just check the box for anonymous before you send in your questions. Also, some great news. For today's session, attendees will be entered automatically into a raffle for prizes. And at the end of today's session, we'll put a link to the survey in the chat, and we ask that you please fill this out so that we can continue making our personal finance sessions a success. So to begin, for today's first session, we have Amber Miller joining us from GreenPath. And I will stop sharing my screen and allow Amber to take over. And as I'm doing that, Amber, I'm going to do a quick bio for you. Sorry, give me a second. Okay. Amber Miller is a partner experience manager with GreenPath Financial Wellness. She lives in Philadelphia with her husband and 3 cats. Amber is extremely passionate about financial wellness and education, has experience developing a financial education program during her time working for a community bank in Kansas, as well as providing credit and housing counseling at GreenPath. She's especially passionate about providing credit education and is thrilled to be here today. Amber, take it away.
Thank you, Terrence. Good afternoon, everyone, and thank you for joining us for this session on navigating credit. So as we dive in, I just want to thank Terrence and everyone at HUECU for the invitation to join you all today. As Terrence said, credit is one of my all-time favorite topics to present about, which sounds a little bit weird because credit can cause people a lot of stress, but that's why I love presenting about it, because there's a lot of information out there, and really diving into providing digestible, understandable content about credit is something that can hopefully make your life easier, and that's what I'm thrilled to be here to do today. So as Terrence mentioned, I am with an organization called Green Path Financial Wellness, and Green Path is a nonprofit organization with a mission to empower people to lead financially healthy lives. And we've been doing this since 1961. So Green Path partners with credit unions like HU ECU to help people on their journey to financial wellness. We are a credit counseling agency certified by the National Foundation for Credit Counseling, and we're also certified by HUD as as a housing counseling agency as well. So for more than 6 decades here at Green Path, we've been here to help people understand and build credit, manage debt, obtain and or retain housing, and so much more. So I personally hold both NFCC credit counseling and HUD housing counseling certifications. And again, I'm thrilled to be here today to talk about the somewhat confusing but oh so important topic of credit with you today. So before we dive in, just taking a quick minute to cover our agenda for this presentation. First off, I want to start out by just covering the basics of credit. Then we'll talk a little bit about why credit even matters. Why is credit important? Then we'll dive a little bit deeper into what actually impacts your credit score before talking about how to build credit from scratch or how to rebuild it after a credit setback or after just not having used credit for several years, if that's a situation you maybe are in. We'll also bust some credit myths and talk about why they aren't necessarily true, before wrapping up by taking a look at some healthy credit usage habits and tips. So let's go ahead and dive right into the basics of credit by starting out by just defining some key terms that you'll hear used when it comes to credit. So at its core, credit is basically an agreement between an individual and a creditor in which this individual receives something now with the understanding they will pay that creditor back later. So this can come in a variety of forms. It could be a loan, it could be a credit card, or it could be a line of credit, which is similar to a credit card where you have money that's available to you. You don't have to use all of it, but you also don't make payments on it until you do use money from that line of credit. A credit report is what shows both your credit history on old accounts and the activity on all open credit accounts. So this shows both how you've handled credit accounts in the past, as well as how you're currently handling your open credit accounts. And in general, things can typically stay on your credit report for between 2 and 10 years, perhaps longer if the account remains open and in good standing for longer than that. And there are 3 different credit bureaus that generate credit reports. Those are Experian, TransUnion, and Equifax. Not all creditors report to all 3 credit bureaus, so there can be some differences between these 3 reports. And it's a good idea and important to keep your eye on what's going on with all 3 bureaus' credit reports. You are entitled by federal law to access a free copy of your credit report from all 3 credit bureaus once a year. So the recommended place to do this would be annualcreditreport.com. Be really careful when you're typing this website in, as there are a lot of imposter sites out there. So looking for that logo in the top left-hand corner that states that this is the source authorized by federal law can help you know that you're in the right place before putting your information in there to get those reports. Again, normally this is available to you for free once a year, but during the COVID pandemic starting in 2020, the credit bureaus actually began offering free credit reports on a weekly basis instead of just annually. I will say weekly is probably a little bit too often to need to check your reports, as it's not something that's typically updated that frequently, but it is good to know that you can access your reports more frequently right now. As with many COVID times things, it's difficult to know exactly when this will come to an end, but be aware that it will probably go back to being free access just once a year at some point. When we think about your credit report, I want to clarify what it does include as well as what's not on your credit report. So your credit report will include your identifying personal information, as well as the information and history of your credit accounts, any bankruptcies, and any collection accounts, typically within the last 7 or so years, as well as a list of who has accessed your credit report. So a credit report will not include your income, your assets, like money that you would have in a savings account, your checking account, your savings account, or what usage you use your debit card for. It would also typically not include bills like rent or utilities. Reviewing your credit report at least once a year is a really good idea for many reasons. First of all, you want to make sure you're aware of everything that's on that credit report and be sure that nothing shows up that you were not aware of or that maybe you forgot about. Second, you want to make sure that everything is correct and accurate. Reviewing your credit report regularly can be one really good way to catch identity theft as soon as possible. So if you start seeing accounts on your credit report that you're certain you did not open, or if you see inquiries of people accessing your credit report that you have not applied for credit with, contact the credit bureaus and place a freeze on your credit immediately to make sure that no one can use your information to apply for credit or open accounts in your name. And then if there are accounts that have been opened up or inquiries placed, you can dispute those with the credit bureau and file an identity theft report with the Federal Trade Commission at identitytheft.gov. Finally, when we think about kind of defining the basic credit terms, your credit score is a 3-digit number that uses that information from your credit report to calculate and help creditors predict how likely you are to pay them back as agreed if they chose to extend that credit you are requesting. So basically, creditors use your credit score to measure how risky it is for them to offer you this loan or extend a credit card with an available limit based on both your history of managing previous credit accounts, as well as what's going on with your credit right now, how many accounts you have open, how often you're applying for new credit, the amount of debt outstanding. All of these things are used to calculate your credit score, which we'll talk a little bit more about here in just a second. It is possible to have a 0 credit score if you have absolutely no credit history at all. But if there is anything on that report, the minimum score would usually be 300, which would be considered a poor credit score all the way through about 579. Once you hit 580 through 669, that would be considered fair. 670 to 739 starts being considered good, with 740 to 799 being very good. And then anything above 800 falls under the category of excellent. The average credit score in the United States varies a little bit from year to year, but almost always falls somewhere in that good range of 670 to 739. One thing that I want to mention here as we're getting started with this presentation and as we go a little bit further here, just because you have a high credit score, it does not mean that you are financially healthy. A credit score is not a financial health score. It is possible to have a high credit score while carrying a lot of debt and having no savings to fall back on, just like it's possible to have a pretty low credit score due to not having hardly any debt, but being more financially stable overall. A credit score is important for a lot of things, but it, again, is not a financial health score. So I want to make sure and mention that here because we're going to talk about some things that maybe make sense from a credit standpoint, but don't necessarily make sense from a financial standpoint. And I want to talk about some of this kind of in the way of weighing what makes more sense for your goals. So just wanted to ground our conversation with this here. All right, so moving into this next section here, I want to talk about why credit matters to you. Why is credit important? We've talked about what credit is. Why does this matter? So I want to just share a few things that credit can impact your ability to do and access, including renting or purchasing a home, turning on utilities in that home in your name, your ability to get and keep some jobs. There are some jobs that require a credit check before a job offer is extended, and some employers will periodically review your credit throughout your employment. So this includes, but is not limited to, military clearances. Credit can also impact your ability to open up some bank accounts and, of course, access loans or credit cards, as well as miscellaneous other things, including car insurance rates, cell phone plans, and more. Your credit history and score can also directly impact how much you will pay to access loans or credit cards by being a determining factor in what interest rates you're offered. So I want to take a look at this example here. So this is a chart that shows the interest rates on a 5-year car loan for $20,000. And these are the rates that we're showing when I pulled this information last week on the 12th of January. So just shy of a week ago when I was preparing for this presentation. So as you can see, the interest rates and the monthly payments and the total interest paid vary pretty dramatically between someone who has maybe a lower credit score versus somebody who has that very good or excellent score. So in fact, someone with a very good or excellent score would actually, in this example, save more than $7,000 in total interest paid compared to what they would have paid if their score was lower. So $7,000 is a lot of money. And so this is a prime example that I always like to share because it really shows the difference in having a higher credit score and the prime example of why credit history matters. So there are different credit scoring models out there. And as we move into taking a look at the credit score factors, we are going to be focusing today on what's called the FICO score, which is one of the most common scoring models that lenders and creditors typically use. There is another common scoring method that is called Vantage, and this is often what like Credit Karma and some of those other free credit tools typically use. So neither of these scores is necessarily wrong or right, but it is important to be aware that there are different scoring models and there are differences between those models. And it's important to know what those differences are and to know that many creditors use FICO. So when you are maybe preparing to make a purchase or preparing to apply for credit, the score that you see on maybe Credit Karma or on a free credit score monitoring tool is probably going to be a little bit different than what the score that your lender or your creditor that you apply for with is going to see when you actually do that application, likely because of that difference in scoring model. So when I was doing counseling here at GreenPath, this is a question I got a lot of, hey, my Credit Karma score said it was this score, but when I applied for a loan, my score was quite a bit different. Why is that? The short answer is they're different scoring models taking a look at different factors. So when we think about that FICO score, which is again the most commonly used one that many lenders use, there are 5 factors that work together to determine what your FICO credit score is. And as you can see, they all have different levels of weight within that score. So the first factor is payment history. So this is also what happens to be the very largest factor impacting your credit score. So making every payment on time every month is one of the very best things you can do for your credit score. Even just 1 month of falling past due on one account can have a really quick negative impact on your score. That score will drop quite a bit quicker than it will bounce back up. So it'll take some time to rebuild that payment history, even with just one payment falling behind 1 month. If you're not sure you're going to be able to pay a bill on time for whatever reason, reach out to your creditor as soon as possible to discuss if there's any deferments or hardship programs you may be eligible for that could help prevent you from falling past due and seeing that credit impact. The second largest factor impacting your credit score is what's called amounts owed, which also includes credit utilization. So creditors want to see that if you have a loan balance, they want to see that you're paying that down and that balance is decreasing, not hovering or even increasing over time, which can sometimes happen with student loans or high interest finance loans. They also factor in the number of accounts that have outstanding balances. And credit utilization specifically looks at revolving credit accounts like a credit card or a line of credit, where your balance could go up 1 month, it could go down the next, there can be some serious fluctuation there. Credit utilization looks at how much of your maximum credit limit you're actively using. So the more credit limit you are using, the closer you are to that maximum limit with your balances, the more risk that creditor sees you as, because you're getting close to using the credit that's available to you. And now you're asking for more credit. And that just is a little bit of a red flag there to that creditor you're applying with. So credit utilization is determined by adding up the revolving account balances and dividing that number by the total of your revolving limits, and that determines that utilization number. So for example, let's say you have 3 credit cards with a maximum limit of $2,500, $5,500, and $2,000. So your total available limits come out to $10,000. Ideally, you do not want to use more than 30% of your limits at any time, and ideally pay those off monthly so you're not carrying a balance. But if you have $10,000 of available credit, that means that you would want to try and keep those balances below $3,000. That is that kind of 30% point, of course. And if you can keep it below 1,000, if you can keep that below 10% of your available limit, that's ideal. So keeping those balances as low as possible will directly impact this second largest factor of your credit score. One other thing I want to point out here is if you're in a situation where you're trying to see the quickest impact on your credit score, I want to clarify there's no quick solution to credit. Credit is something that looks at things over a period of time. But this credit utilization factor is something that does change from month to month, depending on what the balance of a credit card or a line of credit is when it's reported. So if this is something that you've got some money and you want to have the quickest impact on your credit score, again, it's not guaranteed to be immediate and there are other factors coming into play, but paying credit card balances down is something that can be a little bit more of a quicker impact on your credit score versus the other factors that really look at a period of time. All right, moving into the next factor here, length of credit history looks at how long your credit accounts have been open. So this includes the age of your oldest open account and the age of your newest account, as well as an average age of your accounts. The longer your credit history, the better. So creditors want to see that you have a history of managing accounts well over time. One thing I like to point out here, if you have student loans, I know that they can feel a little bit overwhelming and frustrating in many ways, but as time goes on, student loans can actually help a lot of people's credit scores because they're often open for several years. So this actually can contribute positively to the length of credit history portion of your credit score. So maybe that's a small silver lining to having student loans for several years, is it can help that length of credit history be a little bit longer there. I know that for myself personally, my student loans are the longest open accounts on my credit report, so it's benefiting me to have those there from that length of credit history standpoint at the very least. Up next is new credit, which is also known as hard inquiries. So when you apply for credit, let's say you go to HU-ECU and you say, hey, I want to buy a car, I want to apply for an auto loan. They will typically do what's called a hard inquiry, which is where they dive deeper into that credit report and credit score to, again, really assess how risky it is if they extend this loan to you. If you start applying for multiple new forms of credit frequently, this can be a red flag to creditors because they start to wonder, what's going on that suddenly you need a new credit card one month, a new loan next month, and now here you are maybe asking for another new credit card this month. Of course, we all do typically need to apply for credit from time to time, which is understood. The key is really being strategic with when you do apply for new credit and limit those hard inquiries to only when you really need it. Hard inquiries do typically only remain on your credit report for 2 years, but it is something that is important to be aware of and be sure that you're only applying for credit when you really need it. And then finally, credit mix is the last factor that impacts your credit score, tied at 10% with the hard inquiries for the smaller factors there. But creditors want to see that you have a history of managing different forms of credit at the same time. So this could look like maybe having a credit card and maybe a car loan and maybe a student loan, 3 different forms of credit there. Again, this is one of the smaller factors impacting your credit score, but it can help to have a well-rounded mixture of types of credit when they are, of course, all being managed responsibly. So again, while some factors weigh heavier on your credit score than others, all 5 factors really do have an impact on your score and are definitely worth paying attention to closely. So maybe you're in a situation where you're starting from scratch. How does someone establish and or maybe build credit history if they have never had any history? One thing that I always want to start out by mentioning here is that building credit history absolutely does not mean that you have to go into a bunch of debt. It is absolutely possible to build credit history without carrying large debt balances and paying a bunch of interest. How do you do that? I'm so glad you asked. So you know how you have to have experience to get a job, but at the same time, how can you get job experience without being able to get a job? Credit can feel kind of the same when you're starting out with building it. Creditors want to see that credit history to measure the risk level of extending credit to you, but how can you get that credit history without being able to get credit extended to you? So maybe similar to getting like an entry-level job to start building job experience, there are credit building products available that are specifically designed to help you start building credit history with some protections in place to help minimize the creditor's risk. So let's take a little bit of a closer look here over the next few minutes at some of these credit building products. So the first way to build credit is what's called the secured credit card, which typically requires you to make a cash security deposit to open the account. So this security deposit reduces the risk to the creditor because if you don't make your payments on that card, they have that money from your deposit to cover their losses. People with no credit or with a poor credit score often must start with a secured credit card to really be able to build and establish that credit history. So these deposits are typically pretty low, somewhere on average, usually between $200 to $500, but they can be higher in some cases. And with a secured card, you are still required to make a monthly payment on time to build that positive payment history. Your deposit is not used to pay for purchases. It's not like a gift card or a debit card. That deposit is being held to, again, offset that creditor's risk. So you get a secured credit card, you make a purchase on it, you get a bill each month, you pay that bill each month, and then that cycle kind of continues there to build that positive payment history. If you don't pay off the entire balance with your payment each month, then there is interest that would be charged that you carries over to the next month. So it's really ideal to get in the habit of paying off that full balance every month to avoid those interest charges. I recommend picking maybe one small budgeted expense you know you're going to pay for every month anyway. Maybe it's your Netflix subscription, or maybe it's gas for the car, but I guess that's not necessarily a small expense these days. But something you know you're going to pay for regardless that is in your budget, so you know that you can afford to easily pay that balance in full when your statement cycles. I'd like to describe getting a secured credit card like getting an apartment. When you sign a lease, typically you have to put down at least 1 month's rent as a security deposit. The landlord holds on to that deposit, and as long as you keep paying your rent every month, you eventually get it back. But if you don't make your rent payment, they keep that deposit to cover it. Same thing with a secured credit card. You put that deposit down, you get a credit card, you use it, you get a bill each month, you pay that bill each month. But if you maybe max that card out and don't pay, the creditor has that deposit to cover their losses, just like a landlord may use your security deposit to cover your rent if you don't pay. You can also use secured loans as a way to build credit. So HUECU offers a couple of different options, either a share secured or a CD secured loan. So these loans are secured by funds held in either your share savings account or a certificate of deposit, and are used to, again, help you build credit history. So same thing, you make monthly payments on this loan as agreed, you build up that positive history. If you weren't to make those payments as agreed, then the credit union has that permission to take those funds that are being held in your savings or your CD to cover that loss. So again, with both of these, a secured credit card or a share secured or CD secured loan, the priority here is making those payments as agreed, keeping those balances low and paid off on that credit card, and just really using these to your advantage to build that positive history of having open and active accounts that you're showing creditors you can manage on time, you can make the payments as agreed. So then you will maybe be eligible for more additional credit options that don't necessarily require that security deposit. If someone that you trust has a credit card in their name, they could also add you as an authorized user to start building some credit history. I want to clarify a few things here. First of all, typically accounts where you are an owner have more impact on your credit score, but being added as an authorized user can be a good way to start establishing some history. I know some parents will do this for their kiddos early on, add their kid as an authorized user to start getting some history there. I do want to specify here, though, that there is definitely some inherent risk in this, because if the individual maxes their credit card out, or if they miss a payment or something happens like that, that can negatively impact your credit score as well. So if you're considering this, this is something that you want to proceed with caution on, and make sure that you truly, really trust that this person can be a good option to establish positive credit history and not end up causing you more headaches down the road. And again, ideally getting an account in your name as soon as possible is best, because you're responsible for that, you're managing that, you've got that control there. And again, it would typically have more impact on your credit long term. If you're maybe in a situation where you have had credit history in the past, then maybe life happened, your credit suffered, and now you're in a situation where you're ready to rebuild that positive credit, or clean up your credit is a term that people use sometimes. I want you to know that it's absolutely possible to do so. It will require a little bit of patience, but many of the same strategies we just talked about to build credit from scratch can also apply to rebuilding credit after something like a bankruptcy or a foreclosure or repossession, or even if you simply haven't used credit for 5 or 10 years or longer. If you are looking to rebuild positive credit and maybe you have some outstanding balances owed, maybe it's a collection account or something like that, prioritize paying those outstanding balances off. If you have collections or charge-offs, which would be when an account falls far enough past due that the creditor begins attempting to collect that full balance instead of just the past due amount, essentially similar to a collection account. But work on a plan to get those balances paid off. These balances can weigh pretty heavily on your credit score. So while it's possible to improve your credit with outstanding past due balances hanging out, it's possible, but it's much more challenging, much more of an uphill battle to do so. And really, you can only go so far with building that credit score back with those balances still on there. So coming up with a plan to get those outstanding past due balances paid off is a key piece of starting to rebuild credit if you have had a setback in the past. And then using those same credit building products we just talked about, secured credit cards, those credit building loans, and maybe being added as an authorized user can be good options to start rebuilding some open and active positive credit history as well, while you're working on taking care of those old balances. So typically you could start using a secured credit card or maybe a secured loan while working to get those balances paid off. So it's a good idea to do this hand in hand if you can. Begin building that new positive credit history and get that start building up, while also working on cleaning up those old obligations that are holding your credit back as well. Part of the reason that building credit can sometimes feel really overwhelming is that there's a lot of conflicting information out there. Some of that information is flat out not true. Some of that information might be true for some people in some situations, but is not necessarily true for everyone across the board. With credit scores, there's a lot of moving pieces coming into play. You and I could, have the same account with the same creditor, but it could impact our credit scores differently based on the other accounts, the other history that we have on that account, or on our credit reports, our credit history. So I want to take just a couple minutes here. Yeah, Terrence, go ahead.
Hey, awesome. This was a great time for a pause, Amber. We actually have a question in the Q&A, and I'm going to read it out loud.
Great.
This person asked anonymously, I pay all of my cards off in full on time. However, sometimes I barely use my credit card within a given month and my score drops dramatically. Why is that?
I would say that what would be impacting that would be the point at time in which maybe the creditor is reporting to the credit bureaus. And if they're catching it at a point where there would be a balance on there, and maybe there wasn't a balance for the past few months, and maybe they reported at a time where there is a balance 1 month, that could lead to that score dropping dramatically because there being that higher utilization that month, when maybe if it is usually $0 balances. I am not aware of any reason that if there is sometimes a balance and you don't have a balance 1 month, I can't understand why that would be negatively impacting your credit score, especially if those payments are being made on time. So my suggestion would be finding out for sure when that creditor is reporting to the credit bureaus to make sure that that balance is kind of staying steady or lower at that time in which it's reporting. Also, just of course, taking a look, keeping an eye on that credit report and making sure that there's not something else showing up on there that's impacting that score. Another question coming to mind would be what you're using to maybe monitor that score. And it may just be that the credit score monitoring tool is catching that at a weird time in the cycle and it maybe shakes out over time. Lots of possibilities there. If you've got more questions, touch base with the credit union, or you can give GreenPath a call and we can dive into it a little bit deeper with you as well. But those are my initial thoughts on what might be leading to that drop and that kind of fluctuation there.
Okay. Thank you so much for sharing. Thanks, Amber.
All right, well, let's get back here and take a look at a few of the more common credit myths that we hear a lot and why they're maybe not necessarily true. So first of all, one of the most common credit score myths out there is that you have to carry a credit card balance from month to month in order to build credit. So not only is this not really true, but it is a myth that can cost you money. So when you get your credit card statement every month, there's a statement balance and a minimum payment due. So to avoid a late payment, to make sure that you're building that positive payment history, all you have to pay is that minimum payment due by the due date. However, if you only pay that minimum payment and there's a difference between that number and that statement balance, when your next statement cycles, then typically you would owe interest on that statement balance amount that you did not pay. So for example, let's say your statement balance was $50 and your minimum payment due is $20 for that month. If you pay $20, you've made your payment obligation, you're getting marked as that payment being made on time, you're in good shape there with your payment history. But when your next statement cycles, typically you would then be charged interest on that $30 difference between that statement balance and the minimum payment that you didn't pay. If you pay that full $50 statement balance, you would not only get that positive payment history, have that marked as paid on time, but you would typically then not be charged any interest because you're paying off that full statement balance versus just paying that monthly minimum payment that's due. So some people believe and have been told even that they must only pay that minimum payment and make sure that they're carrying a balance into the next month to build credit. And that's quite simply not true. So we actually really encourage you to get in the habit of paying off that entire statement balance you owe in full when you get your statement each month. This saves you money on interest charges, will help you keep your balances lower, which improves credit utilization. And just remember, credit cards are not extra money. So making sure that you're keeping those balances manageable, making sure that you're able to pay those off kind of goes back to that financial health piece there, making sure that you're not getting in over your head with those credit card balances.
Oh, and we have one more question, Amber, if you're okay to answer. Okay, this person asks, as someone who started building credit less than 2 years ago, has no outstanding balance at the end of the month, but has no reliable source of income, what are your recommendations as to how to further build credit? I started off building my credit at a fast rate, but the score is not growing too fast anymore. I understand that building credit takes time, but I wondered if you had any recommendations for the short run.
So like you're saying, it takes some time. Just keep doing what you're doing, staying steady with making sure that those balances stay low. If you've got credit cards, making sure that those payments are being made on time every month. If you don't already have maybe like the share secured or CD secured loan, something like that to get another form of credit in the mix, that could be a helpful way there. If you've maybe got some savings tucked away, looking for options like that. Again, not getting in over your head, because if you aren't sure what your income is going to look like, you don't want to be committed to a payment that you're not sure you're going to be able to make, because that could end up causing more of a headache for you if you have this payment obligation. So I want to encourage you to keep doing what you're doing, but also weigh again that credit score with that financial health piece there, making sure you're not getting in over your head and putting yourself at risk of maybe damaging that payment history if you're in a spot where you're not sure what that income is going to look like. With that credit score, like you said, it's maybe not growing as quickly, but better to have it remain steady than get in a situation where maybe that score drops dramatically because you've committed to a payment that you're not sure you're going to be able to make one month.
Awesome. Thank you so much.
Of course. All right, let's see. So the next myth here would be opening a new credit card every time I get an offer is a good thing for my credit score. You need a lot of credit cards to build credit. So technically, having more available credit limits can help improve your credit utilization, but this is a very dangerous game to play. So when you open a new credit card, first of all, you have that new hard inquiry and you have a younger account in your length of credit history, both of which can negatively impact your credit score. Again, those are smaller factors in the score, but they do have some impact, especially initially. When you first do that application, first open that account, that can be something that you see a quick negative drop on that score with. Often that will offset over time, but the more credit cards you have, the trickier it can be to keep track of due dates and get all of those payments made on time. So there's also a little bit more potential for you to get in over your head with balances spread across multiple cards. There's no magic number of credit cards that's best to have from the credit score standpoint, but typically having no more than 2 or 3 would be typically what's recommended, just kind of from that money management and account management standpoint. Remember also that a mix of types of credit open can help your credit score as well. So maybe instead of opening a new credit card every time you go to the mall and you go into the different retailers that say, if you open our card, you can save 10% today. So instead of opening a bunch of different credit cards, having a couple of credit cards and maybe a loan of some type or two can help improve that credit mix, which again helps that credit history and credit report be a little bit more well-rounded, more than just having a bunch of different multiple open credit cards. The next myth here would be, I should close a credit card after paying it off if I don't plan to use it anymore. This will improve my credit score. So some people think that after paying off that credit card, they should close it. I want to let you know that this can negatively impact your credit score. So you will lose that length of history from the card. It can impact your utilization if that available limit comes out of that mix. Once you open a credit card, from the credit score standpoint strictly, it's best to keep it open as long as you're managing that card responsibly. Even if you don't plan to use it for much, consider maybe setting up a small recurring expense like a monthly subscription, or using it for a specific purpose like gas, and paying it off in full each month to keep that card active and continue to build that account's history can be helpful from the credit score standpoint. However, I want to clarify here that if keeping that card open is a temptation to maybe rack those balances up, or you know that you're going to fall behind on payments, or maybe the card has an annual fee. There are some cards out there that charge you every year to keep that account open. By all means, close that card if you're not going to be using it. This is one of those situations where you have to weigh the pros and cons like this and do what's best for your finances across the board. So yes, closing that card may have some initial negative impact on your credit score, but carrying a high balance or being late on payments would typically have more of a substantial negative impact that can take longer to build back from. So again, like we talked about earlier, this is a prime example of that credit score not being a financial health score. And this is again a prime example of sometimes having to take a bit of a credit score hit potentially to be able to maintain that financial health across the board. Closing an account will probably be a more immediate impact. You'll typically see that within the next reporting cycle happens, but that is something that often can be bounced back from a little bit quicker than some of these other things like falling behind on a payment or carrying a high balance. So again, just really weighing if you're in a spot where you know you're not going to need to apply for new credit or need to use that credit score for anything anytime soon, it may make sense to take that little bit of a hit to close a card if it can help you with your financial health across the board. Next here, another credit myth is that checking my own credit report or checking my credit score will hurt my credit score. So we did talk a little bit earlier about reviewing your credit report and the difference in those credit score monitoring tools. We also talked about how applying for credit leads to a hard inquiry, which can start to negatively impact your credit score when there are too many of them. So some people kind of put those two things together and believe that checking their own credit will also hurt their credit score. So there are two types of credit inquiries. There's a hard inquiry, which is what a creditor or a lender typically does to dive really deep into that credit history to measure their risk level of extending that credit you're requesting. A hard inquiry typically indicates that you have actually applied for credit, and as we discussed earlier, can start to negatively impact your score if done too often. When you check your own credit for educational or monitoring purposes, however, this is what's called a soft inquiry, and it does not impact your credit score. So here at GreenPath, we have financial wellness experts who review hundreds of soft pull credit reports with people every day. It's really important to review your credit reports, keep an eye on what's going on there so that you can react quickly if you notice fraud or if something just doesn't seem right. And the good news is that you are absolutely free to do this, free to keep an eye on your credit without concern about it impacting your credit score. So as we wrap up today, I want to first of all say, if you've got questions here, we're going to talk about some healthy credit habits. But if you've got questions that I haven't answered, please put those in the chat. We'll have, or in the Q&A section, it looks like, either way. Put those in there and I'll make sure that we get those answered. Terrence, anything right now before we wrap up with some of these healthy credit habits and then answer any other looming questions?
Nothing right now. By all means, continue.
All right. Well, whether you are building credit history from scratch, maybe you're rebuilding credit following a setback, or maybe you've got a good credit score and you want to make sure that you're maintaining that score, there are some important healthy credit habits that are, again, really important to keep practicing to build that positive credit history. So as we discussed earlier, again, payment history is the largest factor that impacts your credit score. Again, missing or being late on just one payment 1 month can have that quick negative impact, and it will take longer to build back up than it takes to drop. So this is why it's so important to make every payment on time every month. If you're concerned about keeping track of due dates, I absolutely recommend setting up automatic payments so that you make sure that your bills are paid on time every month and you don't have to be like, oh no, sitting up in bed in the middle of the night thinking, I had a bill due today. I didn't make it on time. What am I going to do? So having those automatic payments set up can be some really good peace of mind to make sure that you know that your payments are being made. If you have student loans, maybe you're in school, it will be especially important to communicate with your loan servicer and get payment arrangements in place before your payments start being due. In general, for federal student loans, there's typically a 6-month grace period after you leave school before payments start being due, which gives you some time to make those arrangements with the servicer to start building that positive payment history. With student loans right now, we have had that payment pause in place during the pandemic. Things are kind of in court, shaking out exactly what's going to happen with the student loan forgiveness plan that was announced. But if you do have student loans that have been in that forbearance with the federal student loan payment pause, currently it's expected that those payments will resume this summer, but it might move up sooner depending on the date that the Supreme Court decision is made about the student loan forgiveness plan. But with that, once that is set into place, once we know exactly when those payments will be due, it will be super, super important to communicate with your loan servicer to make sure that they have your information, to make sure that you get those payment arrangements in place for when those payments resume, so you don't accidentally start falling behind on student loan payments that you haven't had to make for 3 years. This is a great time to maybe take a look at your credit report and see who your student loan servicer is, or go to studentaid.gov and log in and just touch base with that servicer. Make sure that they have your email address, make sure that they have your phone number, make sure that your contact information is up to date there, so that when we have some solid direction on those payments resuming, you know that they're going to be able to get in touch with you so that you don't have to worry about those payments falling behind without realizing it. I also want to specify keeping those credit card balances low is one of the most positive ways to keep that credit history building positively. We mentioned credit utilization, where that credit card balance is compared to the maximum limit, as being the second largest factor that impacts your credit score. So striving to always keep that balance below 30% of the card's maximum limit, and if you can, keep it below 10%. Ideally, paying that card off in full every month is, again, the strongest tip that I have for you from this credit utilization standpoint. Again, trying to just pick one small specific budgeted expense to use that card for every month. Use the card just for that purpose, keep that balance low, and then pay that full balance off when you get your statement for the month. This is a really great way to build positive payment history while keeping that low balance and avoiding having to pay those interest charges if you, again, pay that full statement balance off monthly, and a great way to build that credit history without having to go into debt. Again, not applying for new credit until you need it. Of course, most of us will need to apply for credit from time to time, which is understood. Just, again, being strategic with when you do. However, instead of frequently applying for accounts you do not need, just to see what's available, just to see if you qualify for this, this can, again, start to negatively impact your score. If you get to a situation where maybe you are looking at something like a mortgage and you want to shop around for the best rates on something like that, getting all your ducks in a row and applying with multiple lenders in a short time period can lead to that counting as just one hard inquiry instead of multiple. This allows you the opportunity to shop around for the best deal without having more impact to your credit score. So that's again something that you would want to do in a very short period of time with something like a mortgage to have that impact be limited there. Another thing I want to specify here and just really encourage you is not ignoring bills. So even if you think it's an error, if it's something that you think you don't owe, collections can stay on your credit report for up to 7 years and can have a really quick negative impact on your credit score. I've seen everything from car insurance, cell phones, cable equipment that wasn't returned, medical bills, rental leases broken early, and more sent to collections and weigh heavily on someone's credit. My younger brother actually recently got a credit or a collections notice in the mail for like a $5 internet bill that went unpaid that he didn't even realize was still outstanding. He hadn't paid attention to the communication from the utility company to get it taken care of, so it was submitted to a collection agency and he then had to work with them to get that resolved. So taking care of this as soon as you get a past due bill or notice is really, really important. Ignoring it does not make it go away magically. Even if you don't think it's legitimate, if you think it's an error, you think it's something you don't owe, it's not going to magically go away if you ignore it, but it can make it much harder to take care of later, while also weighing heavily on your credit score if it does get sent to collections. And then again, reviewing your credit reports from annualcreditreport.com annually to ensure that everything looks correct, make sure that you're aware of everything that's on your credit report, and then being able to take action to dispute inaccurate information as soon as possible is important as well. And then finally, did I mention making every payment on time every month? This is worth repeating because it really makes a huge, huge, huge difference when it comes to your credit. And it's the best tip. If you walk away with one tip from this, this is what I want it to be. Make every payment on time every month. Best thing you can do for your credit score. So if you want to take a closer look at your specific situation, I mentioned that GreenPath is a nonprofit organization with a mission to empower people to lead financially healthy lives. And one of the ways that we do that is by offering free confidential financial assessments. So through GreenPath's partnership with HU-ECU, we provide a variety of services. And a financial assessment is basically a conversation that just starts out with gaining an understanding of what's going on with your finances, what financial goals you have, and then working with you to put an action plan into place that you're confident in being the best way to reach your goals. So we'll talk about pros and cons of different options that make sense for your situation, equipping you to make an educated decision on the best path forward to get where you want to be. So specifically in regards to credit, like I mentioned, we can do that soft pull of the credit report and review it with you in detail. And then our financial wellness experts can give you some really specific tailored advice on how to improve your credit score based on your actual credit history. Like I mentioned, there's a lot of moving pieces coming into play here, and the information I provided today is general information. But if we can take a look at that credit report with you, we can give you more specific tailored advice on how to improve your score based on your credit history. So this is something that I would really encourage anyone who wants to improve their credit to give us a call for that free credit report review. The people who asked questions today would absolutely encourage you to do that so that we can really dive deep into your unique situation and get you that clear, specific advice. The credit union is also another great resource for this. Reaching out to them, they can take a look and answer the questions they're able to help with as well. If you would like to talk to GreenPath, you can give us a call at 877-337-3399. You can also visit our website, greenpath.com/partner/HUECU. You can also check out the credit union's website. They've got good information on there about our resources, about their internal resources that they're able to help you out with, and can get you connected with us that way as well. All right, I know we're coming up close to the end of the hour here. Terrence, any other questions that have come in that I can answer before we wrap up?
Yes, there's one more.
Okay.
This person asks, what is the best platforms to use to learn about current changes in financial policy?
would say probably the Consumer Financial Protection Bureau's website is usually what I go to when I want to see the like actual details. News sites, there's could be things that are a little bit different there, but cfpb.gov is their website, I believe. And that's where you can go to make sure that you're getting the most solid, up-to-date information. I will tell you, with like the student loan forgiveness plan that was announced, I actually did a webinar for GreenPath about that and kind of had to dive deep into learning all of this new stuff. And I spent literally hours on the CFPB website getting all of that information because that's where I knew it was going to be reliable. So that would be my recommendation. Any of the .gov websites, Federal Trade Commission website has some information there. Studentaid.gov keeps you up to date with all of the student loan related policy stuff, but Consumer Financial Protection Bureau would be what I would say is kind of the best catch-all for anything going on with financial policies.
Awesome. Thank you for sharing me that.
Of course.
We still have you for a few more minutes, and if you're in the chat, please ask questions now while we have Amber so we can get them answered. But in the meantime, thank you, Amber, so much for presenting. You've been phenomenal, extremely informative, and we're honored to have you here.
Thank you for the invite. It was great to be here.
Of course. I guess we can keep it open for a little while longer if you can stay until 1 or if you have to go.
Absolutely.
Anything in the Q&A at all, and we'll bring it up. Okay. I don't see anything else popping in. I think we'll end it here. But Amber and everyone who attended, thank you so much. If you please reach out to GreenPath, they're phenomenal, and connect with us at huecu.org, and we'll be happy to answer any questions you have. Thank you.
Thank you. Thank you.